to be with you this evening. We're going to bring you this content, and hopefully it'll be helpful for you as you start that journey towards home ownership. And in case you didn't hear our kind of logistical update a few minutes ago, so we really want to make this an interactive session for you. So we really encourage questions. Ken Fleck's going to be working with me this evening, and he'll be taking your questions through the Q&A. So feel free to send us some questions, then we'll bring those to the group to kind of talk amongst the audience and answer anything that comes up for you. So, all right, well, let's go ahead and jump in, and I'll kind of advance our slides here. A little bit about me. Again, my name is Jason Mehta, and I've been in the mortgage industry for just over about 20 years, probably going a little bit closer to 23 years now, I guess. So we specialize in first-time home buyers. And so, you know, we are one of the top originators in some of the first-time home buyer programs. So you're going to hear a little bit more about that this evening. And we do a lot of home buyer workshops for our different partnerships, UC Irvine being one of them. That's probably why you heard about our session this evening. But we get a chance to teach this content about every week or every 2 weeks all across the West Coast. And we're really excited to bring it to you this evening. We're going to spend some time talking a little bit about the CalHFA program. So you'll hear a bit more about that later on. CalHFA stands for the California Housing Finance Agency. So you'll learn a bit more about some assistance that's available to both low to moderate income households. And most of our information though tonight will also be centered around kind of all the wide range of options that are available to you as a buyer, whether you're a first time or even a second time buyer. We're going to discuss conventional loans, FHA loans, VA, USDA loans. So you're going to get a wide range of different products that are going to be resources for you as you, or once you decide to take that next steps in home ownership. So a lot of great things to share with you this evening. Here's some of our talking points for tonight. So we're going to spend some time talking about the housing market in just a bit. That's always a kind of a fun conversation because the market is kind of shifting a little bit. And I'll kind of give you some kind of color around that and what we're seeing in the market, especially as we're interacting with buyers and they're out looking at homes actively as we speak. We'll dive into does buying make sense? So we're going to do a rent versus buying analysis. We're going to kind of do an interactive session with you on that. We'll spend some time looking at credit. Credit's going to dictate generally the cost of your financing. And so we'll talk about credit, you know, how to kind of have some different resources around improving your credit and really what makes up a credit score. We're also going to look at the loan programs, as I mentioned just a bit ago. We'll talk about qualifying income and what that means for you as a buyer in terms of the documentation that's going to be required by a lender. We'll look at down payment assistance. That has to do with the CalHFA program. We'll show you how you could potentially be eligible to get assistance to help with both your down payment and potentially closing costs. And then we'll finish up tonight's discussion looking at what is a personal consultation. That's where we get together and connect with you for a one-on-one, generally over video, to design a home buying game plan for you and hopefully have you in a position where you're pre-approved. So if you do decide to go out and take the next steps in home ownership, you'll know you're fully qualified. And then finally, we'll talk a little bit about the process. What does the process of buying a house look like? 6 steps of home buying is what we call it. And so I'll kind of walk you through that and just so you can have some expectations around like how long is it going to take for me to buy a house when I start that process of having an accepted offer to when I actually get the keys to my house. So a lot of great things for us to share with you this evening. And so let's go ahead and jump right in. And the first question is, you know, does buying make sense? And many of you are joining this evening because you're kind of in discovery right now. You're trying to figure out, you know, what does it look like for me in home ownership? I know that I'm paying X amount of dollars in rent, but how could that translate to me looking at potential home ownership? And when we think about home ownership, there's a lot of great benefits that come along with it. Obviously, you're creating, you know, wealth because now you're going to buy something versus renting something on a monthly basis. But there's a little bit more to it than that. Create stability in your housing payments. So no longer am I worried about my rent going from $2,000 a month to $2,300 a month because I just had to renew my lease. Like I mentioned, it is an asset, so the potential of growth in wealth. We call that home equity. So whatever you owe on your house versus what the market is saying is the house is worth, that difference is what we call home equity. There still is some tax benefits that come with home buying. So while we lost a few benefits, you know, tax deductions still come along with interest deductions. So that's something to keep in mind as well. And then finally, this is an asset. So it gives you the ability to be able to pass along this asset to the heirs of your estate down the road. Okay. So a lot of great things that come with buying. And as we're thinking about buying, we want to look at budgeting because when it comes to buying, especially around repairs, assets, tax benefits, all that stuff, we need to kind of figure out where we're at financially with renting versus what it could look like with buying. So this is our rent versus buy calculator that I'm going to walk us through this evening. By the way, all this material that we share with you this evening, we're going to send to you via email tomorrow morning. So you'll get all this stuff. We really encourage you to take notes throughout tonight, but we will send the material over in the morning. So let's go ahead and dive in. And this link is brought to us by Freddie Mac. And so Freddie Mac is one of the conventional loan options. It's either Fannie Mae or Freddie Mac. And we'll talk more about that this evening, but this is a website sponsored by them. So when we dive into this rent versus buying calculator, we're going to plug in kind of where we're at today from a renting perspective. So let's assume that we're at $2,500 a month in rent. Of course, with that, we're probably paying renter's insurance, which we're going to assume is $20 a month. Let's also assume that our rent's going to go up by about 2% per year. Okay, so when we renew our lease, that rent will jump, from $2,500 a month, maybe push up, close to what, 2%. So we'll save maybe $50 a month in increase. Now that changes obviously for different locations across the state. Now from the home purchase side, let's assume we're going to buy a $500,000 house or condo, maybe a townhouse, depending on where you're looking to buy. But if you did purchase at the $500,000 level, the minimum down payment is 3% usually for a conventional loan, which is $15,000. When you purchase a home, you're also going to have property taxes. Those are usually 1.2 to 1.25% of this purchase price here. You're also going to have homeowners insurance expenses. So homeowners is going to cover any type of perils with the house, like let's say you have theft, or maybe you have some type of water leakage or whatever the case may be. That's where your homeowners insurance would cover that problem. And then you have maintenance, and so when we think about maintenance as a homeowner, no longer can we contact our landlord and say, hey, I don't have hot water, I need help. With that being part of our budget, now we're gonna have to figure out if something goes wrong with my hot water heater, how am I gonna pay for that? And so that's where we're gonna carve out, we put $2,000 in maintenance a year. Obviously, if you purchase maybe an older home, then that might be a bigger budget. Now, one thing, just as a side note, we're going to talk about first-time buyer programs later on this evening. One of the things that comes in as kind of a value add with the first-time buyer programs is a home warranty. And home warranties will provide, it's almost like an insurance policy, but it warranties some of the kind of the interior components of a house, like garbage disposal, HVAC unit. So if one of those things breaks down, you would have a repair person that would be called under the home warranty program to come out and fix those items. So that's with a first-time buyer program. Now let's look a little bit more at loan information. So let's assume we're going to do a 30-year fixed mortgage. If we're not going to buy today, because interest rates are a little bit lower than 3.25, we're going to project out maybe 3 to 6 months. Let's assume a 3.25 rate just to be on the safe side. Origination charges, that's generally what your lender is going to charge you. Now, for those of you that are joining us through our partnership with UC Irvine, there is a $750 discount. So normally there's a $910 processing fee, which is part of this origination charge. That gets dropped by $750. Okay, so that will lower your overall origination cost as part of our partnership. And then discount points are an option for you as a consumer. What a discount point allows you to do is to buy down the cost of your interest rate. So for example, if the projected interest rate is 3.25 and you want to pay one discount point, which equals 1% of your loan. So in this case, it would be roughly about $4,900. If you wanted to pay $4,900 in discount points, that would buy down your rate. Generally, as a rule of thumb, about 0.25%. So 1 point will equal 0.25% reduction in interest rate. So generally with loans and how we structure them, they would be with no discount points, but some consumers do like to take advantage of buying down their interest rate. Now the average interest rate right now is about 2.8 to 2.9%, but if we're not going to buy this month, for example, we want to factor in maybe a potentially higher rate environment. So that's what we've done here with this analysis. And then the other settlement charges are going to be the total of some of your closing costs. Closing costs are usually 2 to 3% of your sales price, give or take. So when we factor in our lender charges, as well as title, escrow, maybe some of the government charges, that's all going to be part of the closing costs. Okay. And then The last tab down here is other assumptions. So when we buy our house, we're going to hopefully have some appreciation in that home. Those of us that own homes now, I've probably seen a lot more appreciation as opposed to maybe going back 3 or 4 years in this kind of a crazy market. We're gonna spend some time talking about the housing market in just a bit, but appreciation rate we'll assume is 3%. And then expected years in the home, that's how long we're going to stay in the house. So let's say 7 years. And then this line item here for selling costs. And what that means is the cost of me selling my home in 7 years from now. Now, as a buyer, we don't have to pay the cost of a realtor. So when you have what we call a buying agent that represents you, that's always paid for by the seller. Now, eventually, when you sell your home 7 years from now, you're going to be paying the agent commissions for both the buying agent and the listing agent. But today, at least as a buyer, we're not responsible for paying the realtor commissions. And the last two items is state and federal taxes, which we've factored at 33.8%, and then the savings rate at 1%, could be 0.5%, but let's just say 1% for now. So what this calculation does is it says, okay, Jason, if I'm going to continue to pay rent at $25.20, give or take, per month for the next 7 years, versus my mortgage payment. Now my mortgage payment is $32.81, so it's about $700 higher on a monthly basis. If I continue to pay rent versus buying, my total cost of renting over the next 7 years is $216,766. So take that 25/20 times the next 84 months. That's how much I'm paying out in rent. As opposed to on the buy side, yes, I'm going to be paying $700 more a month, but my opportunity when I look at buying between taxes, tax write-off, but more importantly, with my equity appreciation and of course my asset that's growing, the difference of buying is about $94,983. So if I take my asset that I purchased at $500,000 and grows over time for the next 7 years, the opportunity is just over $94,000. Okay, so that's the rent versus buying analysis. Like I mentioned earlier, you're going to be able to kind of do that analysis yourself. We'll send you all the presentation material so you can get a chance to jump into that link and do it yourself. Let me screen share that. Okay, so I'm going to go ahead and jump back to our slideshow here. So just give me 1 second. Not a good transition. Okay. All right. Okay, so we're back. All right, so that's the rent versus buying calculator. Now, one of the things we talked about during that calculation is, what's the housing market doing? And so when we compare that to, rent rates are still starting to rise a bit, and they rise a little bit higher in certain areas. We're starting to see more of our densely populated areas, like some of our downtown areas, both in northern and southern California, starting to rise a bit in rates. But on the housing appreciation side, that's where we're seeing pretty swift inclines. And really the appreciation is attributed to lack of inventory, huge buyer demand pushing prices up. What's inside of those numbers when we look at across just the Southern California markets, it's a few things. Like I mentioned, lack of inventory, high buyer demand. The lower interest rate environment is also creating, a larger buyer appetite. And I think, with what we're seeing right now with the limited inventory, buyers are, more than likely having the choice of maybe working from home. And so the buyer behavior looks a little bit different than it has in past years. So still being in the middle of the pandemic, more buyers are staying at home to work. And so that kind of changes, where they would consider buying. So I think those three things are really kind of fueling this housing market. But we are starting to see a little bit of a shift, not necessarily from the buyer behavior, more so from what the seller's expectations is looking like. And we're seeing that all across the California markets. I'm starting to see, whereas we had maybe 30 to 40 offers 3 months ago, now we're seeing maybe 10 to 15 offers. And if we have some sellers that are much more aggressive in terms of how they've priced their home, those homes are now starting to sit longer on the market. In some cases, they're starting to see price reductions. And so that, I think, is much more favorable, especially for our first-time home buyers that we're really trying to get into the market and they're competing against other buyers that maybe have 20 or 30% down, or maybe they're even cash buyers. I think sellers are more apt to consider our first-time home buyer offers. And so I think that's really encouraging. So as we move into the balance of 2021 and hopefully into 2022, it should be a much more favorable market for buyers to be able to enter. And, you know, there still will be competition because there'll be other first-time buyers looking at that same property, but I think the competition is starting to lessen a little bit, and sellers' flexibility is starting to improve. So as we're looking at kind of the short-term effects in the market, and you know, I've kind of spoke about this already, but you know, as we went through the entered the pandemic, we saw a lower interest rate environment. Buyer demand started shifting. We started seeing lack of inventory because the sellers, quite honestly, were afraid to put their homes on the market. That shortage of inventory, high buyer demand really created that swift move in prices. And we really saw that go all the way through 2020, all the way into 2021. And we're still, like I mentioned, kind of where we're at right now. So hopefully we'll see more inventory come online. We are seeing some buyers that are shifting their focus from resale homes, which is dependent upon the inventory levels, to maybe looking more at new home sales. And so I think as you're seeing, especially in our Southern California markets, we're seeing more and more new home communities pop up, especially in the Orange County market. Some of our, you know, kind of Eastern LA County, we're seeing more new construction opportunities. And then we're starting to see more people that are considering buying in more of your outlying areas, your Palmdales, your Riverside, your San Bernardino areas. So that's the kind of the short-term effect we see in the market. Now, what's the long-term effect? We don't really know. I was reading an article, I think it was the Wall Street Journal just this past weekend, you know, kind of the question around, is there a housing bubble coming? And it doesn't seem to indicate that there is a housing bubble coming. You know, we do have a bit of a shortage when it comes to housing. So we got to figure out, like, how do we solve for that? And some incentivizing maybe developers for more affordable housing that's out there. But ultimately, kind of what we're seeing is not necessarily a housing bubble. But one of the concerns right now is part of the CARES Act that was enacted to stem potential fallout in the housing market allowed existing homeowners to be able to do basically like a forbearance on their current mortgage. So which would allow them to take a break of up to 6 months in deferring their payments. Well, some of those forbearance now are coming due. And so not all households have changed their economic position. So maybe those people have not, you know, obtained new employment. So maybe that's still a bit of a financial struggle. So we'll see how current homeowners that maybe are having some financial difficulties, how that kind of shakes out. Hopefully there's going to be additional support for them in terms of more forbearance as they allow them, as they're able to kind of get back on their feet financially. So we'll kind of see what happens with potential issues there. But right now, we're not seeing any type of major shifts in the housing market, other than we're starting to see some pricing reductions in the now from existing sellers. Okay. Let's take a quick pause. Are there any questions that I can help answer?
We have one around down payment if you want to answer it now.
Sure.
So looking at a loan amount above $850, what are some of the minimum down payments for that type of
okay. So a question came in on down payment, but I think now I think about, we should probably defer it till we get to later in the stage, but later in the presentation. But I'll comment on it really quick. So the question was for loan amounts that are above $850, what are some of the down payment options? So that's going to be more in the jumbo loan product set. So that generally requires at least a 10% down payment. And so we'll talk more about that a little bit later on. We do have jumbo loans with 10% down up to, I think it's $1.5 million. But I'll spend some more time to talk about that a little bit later. But that's a good question. Let's talk a little bit about interest rates. That always seems to be a hot topic, especially as we're consulting with buyers throughout the day. So when we look at interest rates, the average interest rate is kind of bouncing between 2.8, 2.9%. You can generally find much lower interest rates than what I just indicated looking online, because the way interest rates are marketed by competing lenders, there will be costs associated with the interest rate. So you may see 2.2 or 2.3, but what you generally won't see is how much it's going to cost to achieve that rate. So and that would be discount points, like we talked a little bit about earlier. That average rate of 2.8 to 2.9 is with no points today. So that's what it looks like today. Now, let's look back a bit, over the past 30 years with interest rates to kind of see how we've gotten here, so to speak. So when you look at the early 90s, interest rates were like almost double digits. As you can see this graph here, we're almost to 10%. And of course, home prices were about a third of what they are today. But nonetheless, interest rates were much higher back then. So as we move through, the 90s and the 2000s, we start to see interest rates start to move now closer into like more of a 5-6% position. Then you start seeing interest rates kind of leveling out for the most part. It was kind of choppy here through 2000. And then as we enter 2009, then we start seeing a pretty deep drop. Part of that was certainly the housing collapse that we saw in 2008, 2009. And then, kind of what the economy was doing. Interest rates started moving, we saw stuff going below 4%. And up until that point, we really didn't see anything that was sub 3% until we got into 2020 to see interest rates now moving into we had some levels, we saw interest rates in the 2.5 to 2.6 range on the 30-year fixed as we kind of get into today. Now, what interest rates did, kind of looking at the last year and a half, when we actually entered the pandemic, we saw interest rates go from, high fours until, I should say high fours, probably low fours. And then we started seeing rates drop down to 3.25. And then we saw right around March, we saw rates go close to 3%. And we thought that's about as far as we would go down. And then we started seeing this additional movement, and interest rates ultimately got down to about 2.5 to 2.625 on the 30-year fix. When we entered 2021, and I remember this weekend when it happened. So about Valentine's Day weekend, we start to see interest rates start to inch back up, which is this kind of movement you see right here, where interest rates started going back up to the low 3 to mid 3s level. And then now we've seen interest rates start to come down as of recent. So today, that's where we're kind of entering around this 2.8 to 2.9 level. And then we'll see where interest rates go from here. And that's kind of the bigger question, because there is talk that the Federal Reserve, which is purchasing mortgage-backed securities, and that's helping kind of suppress these interest rates with inflationary concerns. There is talk that they may start to taper or kind of peel back a little bit on some of the mortgage-backed security purchases. And that could lend to a higher rate environment as we move into the end of 2021. We don't know what that looks like at this point. There is talk that they could start beginning the tapering in October. It could be end of the year. It could be first quarter of 2022, but we just don't know at this point. So, as we're looking at future home buying, so if you're 3 to 6 months out on this, we got to kind of figure out there may be a 0.25% to maybe 0.5% increase in interest rates over the next 6 months. So it's certainly something we want to budget in as we kind of look at our different home buying options. One other quick comment here for us on interest rates, because this comes up as a conversation piece when we're meeting with clients, because there is talk at times that adjustable rates could be an option to help me get a lower payment. But when we look at the environment that we're in right now, adjustable rates mean that at the end of a certain fixed period of time, those interest rates will adjust and they'll go up. So usually it's a 5-year, 7-year, 10-year fixed period of time. When we're in this low rate environment, adjustable rate mortgages just do not make sense. And generally they don't make sense at all for first-time homebuyers, because it's not a predictable type of payment, because at some point you're going to see a change in interest rate, which will influence your monthly payment. We really want to make things predictable, especially for first-time buyers. And that's where 99.9% of first-time buyers will use a 30-year fixed mortgage. So that's because that's just a much more stable product. But in this environment, when you have such low long-term interest rates like we do in a 30-year fixed, it just does not make sense, if at all, to consider a 5-year fixed mortgage. And generally, it's not even, doesn't make sense even in a higher rate environment, but it becomes more of a tough conversation when have rates in the 4s or high 4s, because the adjustable rate could be running a little bit lower in the 3s. So just something to think about as a future buyer. But for the most part, we'll be considering 30-year fixed mortgages as our different options. Okay, so that's interest rates, and we're going to kind of transition from interest rates into credit. And what's cool about credit, especially in this day and age, everybody has some type of visibility around credit, so they kind of know what their scores look like. When you're monitoring your credit through Credit Karma, TransUnion, Experian, Equifax, whatever the case may be, usually you're getting a credit card score. So that is going to differ from what a mortgage lender or even an auto lender is going to pull. So there's usually 3 different models. There's auto, credit card, and mortgage. So even though we may be at a 750 on Credit Karma, and let's say we pull your credit may be a 720 on the mortgage score, it's just because there are different risk factors that are part of the model for mortgage that maybe are not as heavily weighted on the credit card model. Let's take a look at how FICO is kind of constructed. So this is the FICO score calculation. 15% of the credit model is how long I've had credit. So the more mature my credit file is, the higher potential score I have. 20% of it's how long I've had credit in use. But more so what we're looking at is new accounts that are established. We're also looking at new credit inquiries. So, and those are hard inquiries. There is credit rules out there that you can apply with as many mortgage lenders as you want in a 30-day window of time, and it's the equivalent of one credit inquiry hit to your score. Same thing holds true for auto financing. So if you run down to the auto mall and you're shopping for the best rate on a car loan, you have the opportunity to shop around with many lenders as you want in a 30-day span of time. Now, when we start your consultative process with us and build your home buying game plan, we use a soft credit pull, which doesn't impact your credit score. So it just allows us to get visibility to your Equifax score. Most lenders will start with a hard inquiry, but we try to do it as a soft inquiry to make it a little bit more easier for the buyer. Now, the more accounts that you open up, so new accounts that are established, that can negatively influence your credit score. So if you're trying to obtain a lot of credit, not just inquiries, but you have new accounts showing up on your report, that could also bring down your credit score. Now, 30% of the score model is how much you owe. So we'll also call that credit utilization, which we have a little bit of a bullet point here under our score factors. Credit utilization is the amount of credit balances versus the amount of credit limits. So ideally, when we have our credit balances of, let's say, $5,000, not ideally, but let's say we have our balances at $5,000, your credit limits are $10,000, that means I'm at 50% utilization. When you start getting up into the 60, 70, 80, 90% utilization, you're going to see some pullback, pretty significant pullback in your credit score. If you are running in around 70 to 80% utilization, you want to start by trying to bring those credit balances below 50%. If you've already mastered that, and you're just trying to optimize your credit score, which, by the way, the highest credit score generally is 850. You want to try to get that credit utilization below 10% of the credit limit amount. There's a little trick I like to share with our audience when it comes to trying to manage credit utilization, and that has to do with the billing cycle date on your credit cards, because when your billing cycle ends on your credit card, that's when the balances are reported out to the credit agencies, and that will influence your utilization. So when you look at your credit card statement, let's say you look at it this evening, there's going to have a billing cycle date on it. So let's say it's on the 20th of the month. Your due date is probably going to be in the following month or shortly thereafter. So let's say it's on the 4th of the month. Whatever your balance is on the 20th of the month, that credit card issuer is going to post that balance out to the credit agencies. So even though you're going to pay that $3,000 balance off on the 4th of the month, the bureaus are still going to pick up that $3,000 balance that you had at the end of your billing cycle. So what I always recommend, and what I personally do with my credit cards, I pay it off before the end of the billing cycle date. So if I know I'm going to have $3,000 in charges, I look at my billing cycle date and say, okay, I'm going to pay that off on the 19th because I want a zero balance to show on my credit report. And so if you do that, that should generally influence your credit score to the positive and hopefully allow you to get a higher credit score. Because when we meet with clients during our consultations, oftentimes they'll say, well, hey, Jason, I don't owe $3,000 on my American Express. I pay it off every month. You probably do. The difference is the credit bureaus are picking up the balance at the end of the billing cycle date. So that's what we pull when we obtain your credit report. Okay, so that's credit utilization. The final component is payment history, and that's pretty simple, like how you've paid your bills. The credit bureaus rate delinquencies at 30 days late, 60, and 90 plus. Obviously, the higher your days of delinquency, the more impact to your credit score, and the lower it can bring your credit score. Delinquencies that you've had on your credit report are going to be most impactful in the last 12 to 24 months from the date of delinquency. So what I mean by that is if I had a late in August of 2020, I'm still inside of the 24 months, but I'm just outside of 12 months. It's going to start organically improving on my credit score the further I get away from that last delinquency on my credit report. Now, if you have collections or charged off accounts that are still reporting, and those are continuing reporting, those are things we're going to want to make some type of adjustments with. Collections are a little bit tricky, whether it's a medical collection or just whatever it might be. Collections are something that even though you pay them off, the collection will still have a negative impact to your credit score. So what I always recommend to clients during their consultations, if we have a collection that pops up and they're just unaware of it, I would contact a collection company, see if they'll take a settlement. Let's say you have a $100 collection, see if they'll take the payment in full, but as part of accepting that payment, have them delete that collection from your report. That's the only way it's going to improve your credit score. Just simply by paying off a collection will not give you the improvement on your credit score. We're going to talk a little bit about past challenges and whatnot in just a bit here as part of our credit component of tonight's discussion. I want to talk to you really quickly about account closure because that's pretty important. If you decide to close out an account because maybe you're switching credit card users and maybe you just want to take advantage of the benefits of this other maybe Capital One card, but then you close out an account that you've had for the last 10 years, you want to be careful of closing out that credit card. You may stop the use of it, but you don't want to close that out because once you do that, that basically pulls away all the great history from that account into the credit bureau, and especially around the 15% component of length of credit. If you close out that account, it could potentially drop your credit score because not only do you have a new account reporting with this new Capital One Visa, but you've also closed out an old account. So you just want to be really careful with that. Now, going back up to the top of the slide with requirements around minimum credit scores by product, each program is going to have a minimum credit score. So FHA is 600, conventionals is 620, Open Door, we're not going to spend some time talking about that this evening, but it's a first-time buyer program, is 640. And then the CalHFA assistance program, which we will spend some time talking about, is a minimum of a 660 credit score. So credit score is a really important component to your financing. It's not only going to impact your program offering, but also impacts things like interest rate and your mortgage insurance, which we'll talk about in just a bit. These are some of the, I guess, just kind of more informational for you as you're looking at past credit challenges. So if you've had any, well, when you have inquiries, hard inquiries, that is, those will be on your credit report for 2 years or less. Late payments, collections, judgments, those are going to stay for at least 7 years. Bankruptcies, 10 years or less, and that includes like tax liens. Federal student loans that are like in default or federal tax liens, those will be on your credit report indefinitely. It's really important that, especially if you're going to go through the home buying process, if you do have any type of past collections, if you will, federal debt, you really want to resolve that because as lenders, we have to go through some reporting mechanism to verify that there is no federal delinquent debt. So if you've had some student loans that have had some challenges, you really want to make sure those are brought current if necessary. Let's talk about student loans because student loans are just part of us designing your financing for you. And so that's one of the obligations that we'll have to count into your qualifying. Generally with first-time buyers, there's usually 2 different program paths we go down, which will either be a conventional loan or an FHA loan. Up until about 3 weeks ago, FHA had a different interpretation on how student loan payments were calculated versus conventional loans. But ultimately, kind of here's what it looks like. Conventional loans, if I have $100,000 worth of student loan debt and I'm on an IBR payment, so income-based repayment amount, and let's say that's $350 per month, that $350 per month is the amount that's going to be counted against us for qualifying. Now, if I'm back in school and my loans are deferred right now, we still have to count a minimum payment against you. Or let's say if I'm in forbearance, I know most federal student loans are not starting again until January of 2022, but there has to be a minimum payment accounted against you. Now, if your income-based repayment amount is 0, then that 0 amount is what we're going to use for qualifying purposes. Now, with FHA loans, like I said, about 3 weeks ago is a little bit different because we had to take that same $100,000 and count 1% of the balance against you in qualifying. So, prior to 3 weeks ago, we'd have to count $1,000 a month in monthly obligation, but that's no longer the case. So FHA aligns a little more closely to conventional loans. So we can either count 0.5% of the balance, which would be $500 a monthly payment, or if the buyer is on an income-based repayment amount, we can use that payment amount to qualify. So that's much more favorable for the buyer because what we found with FHA loan clients, unfortunately, when you add on $1,000 budget into the total obligations, it really can make things a bit challenging for qualifying. So this is a bit more flexible in terms of the repayment guidelines. Okay, like I said, if you're back in school, if you're on forbearance, we're gonna have to count some type of payment against you. for qualifying, and that's something we'll kind of talk about during your consultation. Okay, so let's look at some of those loan programs. I know I just talked a little bit about conventional and FHA loans when it comes to student loans. I know we had the question about jumbo loans and the minimum down payments, so we'll spend some time diving into that now. So there's kind of 5 core product paths that we can go down as a buyer, whether it's a first-time buyer or second or third-time buyer. It's usually conventional loans, which has a minimum down payment of 3%. It's 5% for any clients that are purchasing with loan amounts above $548,250. This gets a little confusing because anytime you go above a loan amount of $548,250 up to $822,375, the minimum down payment jumps from 3% to 5%. It's called a high balance loan. It's still a conventional loan, but for our higher cost of living areas like Orange County, LA County, the Bay Area, Sacramento even has their own high balance, although it's not as high as LA and Orange County. That space above $548,250 to the maximum loan amount of $822,375 is called high balance. So that increases the down payment. In some cases, it can change your interest rate a little bit, up to 0.125% difference. Not a huge difference, but it changes nonetheless. Now, FHA loans have a minimum down payment of 3.5%. They too also follow the maximum loan amount of $822,375. If you're joining us from San Bernardino or Riverside County or maybe San Diego County, those limits look a little bit different. The information we're giving you this evening is specific to Orange County, but we can certainly give you I think we have a slide for that with the loan limits. In fact, I think it's on the next slide. Yeah, so here's some of our neighboring counties. So Riverside's $548,250, San Bernardino is the same. Then you have Ventura at $739,450 and San Diego County at $753,250. So those limits look a little bit different in some of those other neighboring counties. So FHA minimum down payment 3.5%. If you put down 10% for FHA loan, that changes a bit of the mortgage insurance, which we're going to talk about in just a minute. VA loans for our veterans that have served, it's 0 down payment. Generally, that's a minimum credit score of 600 to 620. USDA loans, and they're becoming a little bit more popular. Those are for some of our rural areas. And so those have a minimum down payment of 0. And those will go up to a maximum loan amount of $822,375. Now, USDA, it is designed for rural areas. So there's 2 kind of big restrictions on those products. One is it's a geographical restriction. So only certain kind of lower populated areas qualify for USDA, and there is income restrictions around the income per household size. But that's becoming a little bit more popular in terms of the product offering. Now, we had the question earlier about jumbo loans. So if you do go beyond $822,375, it does go into a jumbo loan. The minimum down payment is 10% on that particular product for 10% down. It will go up to as high as a $1.5 million loan amount. Now, jumbo loans aren't typical for first-time home buyers, but certainly in our higher cost of living areas, it's kind of just something we have to grow accustomed to. And with jumbo loans, there's a little bit of additional asset requirements on that product, and it's a thing called reserves. So in addition to our down payment of 10% plus our closing costs, which we talked about a little bit earlier in our buy versus rent, it's usually 2 to 3% of your sales price. Now, when I start getting into the $1 million range of purchase prices, it's not probably going to be 2 to 3%. It's maybe 0.5 to 1%, but we still have to carve out both the down payment and the closing costs. But in addition to that, jumbo loans generally require reserves. What reserves are is assets that I have. Those can be liquid, those can be secured assets like 401ks, 403bs, brokerage accounts. Those are assets that I have in addition to my contribution towards down payment and closing costs. Usually it's the equivalent of 12 to 18 months of our principal, interest, taxes, and insurance payment. So let's say my mortgage payment's $5,000 a month and there's a 12-month reserve requirement, then I would need to have $60,000 in additional assets after I've contributed the down payment and the closing costs. So jumbo loans, at times it can be a bit of a fear factor where people are concerned that they go over $822,375. Jumbo loans are going to be difficult, but they really aren't difficult. It's just a question really more, there's going to be more requirements, especially around the asset requirement. Okay, I want to kind of skip back a little bit, talk more about conventional and FHA loans. So as you'll see at the bottom of this slide, there's just a quick information around private mortgage insurance, or also known as PMI. So PMI is required when you put less than 20% down. And it looks a little bit different, actually a lot different between conventional loans and FHA loans. So with conventional loans, when you put less than 20% down, you do have mortgage insurance. Mortgage insurance is based upon credit score, loan amount, and down payment. So the higher your credit score is, the more you put down, the cheaper the mortgage insurance is going to be. Now, just as a quick side note, I've had a lot of conversations with clients around like online calculators, especially when you go to like maybe Zillow or Redfin and there's a mortgage calculator. What I've heard is that some of those mortgage calculators don't necessarily factor in, higher credit scores for the mortgage insurance. So the mortgage insurance can look wildly expensive. Conventional loans, believe it or not, can actually be pretty inexpensive from a mortgage insurance perspective if you do have higher credit scores, especially credit scores that exceed the 720, 740 level. If you're at 800, it's going to be the most inexpensive mortgage insurance. So conventional mortgage insurance are based upon those three components. FHA mortgage insurance does not make a difference on credit score nor down payment. Well, to a certain extent, down payment. If you put 3.5% down, which is the minimum amount, the mortgage insurance lasts the life of the loan. And usually the mortgage insurance premium is at 0.85% of the overall loan amount. Plus there's upfront mortgage insurance, which is the equivalent of 1.75% of the loan amount. So that gets added into your amount finance. The challenging thing at times with FHA loans is the FHA loans do not have a cancellation option for your mortgage insurance. So you do have to keep it for the life of the loan, which is 30 years. If you put 10% down or more, then you have to keep the mortgage insurance for 11 years. And there's a slightly lower cost on the mortgage insurance. It drops from 0.85 to 0.80. Now, when we compare FHA loans versus conventional loans do have a mortgage insurance cancellation option. So when you have at least 2 years in the home and 22% equity, you could potentially cancel the mortgage insurance. So when we think about those different product options, you may think, well, why would I want to go with FHA versus conventional? Because it sounds like FHA's mortgage insurance is more expensive and I'm going to have to keep it for 30 years. It just depends because everybody's situation financially is a little bit different. FHA is going to be much more lenient from a credit perspective, as you saw on the previous slide, as opposed to conventional. When we look at maybe past challenges like maybe a bankruptcy or foreclosure or short sale, FHA has a lesser seasoning time period. So when I can buy again versus conventional loans, for example, with a past bankruptcy, FHA will allow you to buy again in 2 years versus conventional loans want 4 years. Or if I've had a past foreclosure, it's 7 years for conventional. I think it's like 4 years with FHA. So those differences may have us go down a different path with FHA or conventional for our upcoming home buying. Okay, again, there's the conforming loan limits, what I just showed you just a bit ago. And we'll also, again, share this information with you tomorrow morning, so you'll get this slideshow. You can make your own notes there for yourself. All right, let's talk a little bit about income. And we'll talk about some kind of misconceptions around, especially around home buying when it comes to proof of income and how long I've been on the job. And this is some of the documentation that's required. So as a W-2 wage earner, usually I'm going to need your last 2 years of W-2s, my most recent 30-day pay stubs, and then eventually through the process, we're going to do a verification of employment. That's usually done written and it's also done verbally. If I'm self-employed, we are going to have to ask for more documentation. Usually it's the last 2 years of tax returns. Depending on if I'm incorporated or not, we may ask for additional information. There's a year-to-date profit and loss statement and usually a balance sheet that we request. And then we'll need to verify the employment, the business, whether that's through a CPA letter, website, business license, whatever the case may be. So that's kind of what the documentation looks like. Now, if I'm maybe driving for Uber and I also work as a full-time position, we'll need to get your last 2 years of W-2s and then your 2 years of tax return, because driving for Uber, I'm a contract employee. So we file what we call as a Schedule C income. So we would want to see that in qualifying for your home purchase. If you are in a scenario where you have full-time employment plus you have dual employment with business income, we have to be able to see from a qualifying perspective that you've been doing both positions for the last 2 years. So that's generally what we're going to request. Now, if you maybe work in the healthcare industry and let's say you work at one hospital for 20 hours a week and the other hospital for 30 hours a week, that if you're doing both both positions, to count both sources of income, you have to show that you've been working there for 2 years continuously with both positions. Now, one of the misconceptions we do here, and especially around 2 years, is that do I have to be on my job 2 years to count my income? And that's actually not the case. So the way it works in lending, you have to show either 2 years in the workforce, or a combination of time in the job and education. So the example I like to use is, let's say I went to UCI, I graduated with an accounting degree, and I have my 4 years of accounting education, and now I'm going to work for an accounting firm in Irvine. Because I've spent the last 4 years working on my career here with my education, that would fulfill the 2-year requirement. So even though I'm going to have a short amount of time on my job with this accounting firm in Irvine. Now, the other thing too is we can count your future income simply by, if you have an offer letter, executed offer letter, we can use that to count towards your income. So let's say I'm going to graduate, or I graduate in the spring, but I don't start my job until, let's say, October 1st. If I have an executed offer letter now, we can use that to help with your qualifying. And as long as you get your first paycheck before your first payment is due on your new mortgage, that income can be completely used. Now, if you're transitioning jobs, let's say that you've been on your job for 10 years and now you got an opportunity to go work for a different employer, increase your income. Even though you're not going to be on that new job for 2 years, we can still count that income as long as you're not transitioning from maybe a base salary position to straight commissions. As long as it's like a comparable compensation package, we can use that future income for the new job. Another thing that comes up a little bit is part-time income. So if you're on a part-time job, or maybe you're a contract employment, you do have to be in that position for at least 2 years. Okay. Question? Okay. All right. If you have any income questions, feel free to chime in with us, or ask us a question, and we'll kind of chime in with the answer for the group. But that's typically what comes up when it comes to income. Now, one of the things that as lenders we look at is a thing called debt to income ratio. We look at your monthly obligations as it stands today. So we look at your personal loans, credit cards, student loans, auto loans, anything like that. And we look at that versus your pre-tax income or gross monthly income. So all lenders look at this calculation called debt to income ratio. So we take those obligations versus the gross monthly income. And usually we don't want that to exceed more than 43 to 45% of your pre-tax income. Now, if you think about it, you're probably paying, well, you are paying taxes if you're a W-2 wage earner. And so that gross figure is not what you use to take care of your household expenses, your entertainment, and all that stuff. So that calculation seems to be a bit aggressive. It's not, when we look at your affordability, that's going to be a completely different conversation during our consultation, because we want to talk about where you're currently at right now from a rental perspective. So if I'm paying $2,500 a month in rent, we really want to understand, what's that going to look like if I'm trying to pay, say, $3,200 a month in rent? Is that affordable for me? Even though you may qualify with your debt to income ratio, as we look at as lenders, we still want to make sure that's affordable for you, because we want to set you up for success with your home buying. This is what debt to income ratio looks like in that calculation. So it's principal and interest, taxes, insurance on the new house. So that's your mortgage, which is principal and interest, property taxes, homeowners insurance. And then if you put less than 20% down, we know we have PMI. So we have the private mortgage insurance. And then HOA would be for properties that are maybe condos, townhouses. If that all comes up to, say, $3,000 per month, and I have monthly debts, maybe I have an auto loan of $500 per month. If I take that $3,500 versus my pre-tax income of $9,500 a month, my debt to income ratio is 36.8%. Okay, so that's within the income limit, or within the qualifying ratios for a lender. And that generally is going to be kind of the sweet spot for a first-time buyer, because with the first-time buyers that we work with, usually they feel comfortable around a 33 to 36% debt to income ratio. I met with a couple earlier today. They felt comfortable more around a 29% debt to income ratio. So it really just depends on where you kind of have yourself budgeted monthly, but 36% seems to be kind of where we would probably want to aim towards. Okay, so when we look at home buying, there's kind of, as I look at it, there's kind of like 3 key components to home buying. There's going to be credit, which we've talked about a little bit earlier. There's going to be your source of income. And then the third pillar, if you will, would be down payment, or what my asset position looks like. So when we think about assets and what lenders are going to require for verification, usually we're going to look at checking and savings accounts for assets, but brokerage accounts can be used, 401ks, 403bs, IRAs. Cash deposits aren't acceptable because everything has to be paper trail in lending. So we can't just have some kind of undocumented deposit. Everything has to be paper trail. Gift funds can also be used. Gift funds are when a family member helps you out with your home purchase. So in some cases, there is no minimum contribution from the borrower. If you have a family member that's willing to gift the entire amount of down payment and closing costs, totally allowed. Even on the first-time buyer program, which we're going to talk about in just a bit, you can accept gift funds in addition to your assistance funds if you so choose to. Okay. Now, as we've kind of learned throughout tonight's discussion, when we look at home buying, we are going to have to prepare ourselves with down payment, or have ourselves prepared to have down payment available, as well as closing costs. And certainly if we look at jumbo loans, we have to look at reserve requirements as well. And for the most part, on average, what we see is most buyers needing about $25,000 to $30,000 saved to be able to kind of take the next steps in home ownership. And now obviously it changes a little bit based upon your purchase price. But when we look at home buying and maybe the challenges of saving, down payment assistance can be a great solution to help solve for some of the assets needed to purchase. And so we partner with CalHFA, which CalHFA is the California Housing Finance Agency. And what that agency does is it helps low to moderate income households in home buying. So there's two components to CalHFA. There's the My Home product, which helps towards down payment. And there's the ZIP assistance program that helps towards closing costs. And what we do as part of our consultative process, we'll design financing around those assistance programs if you so choose to do that. Assistance programs, like I said earlier, can be coupled with even gift funds or your own funds that you have saved for your home purchase. There is no maximum asset qualification, if you will, for the assistance program. So how it works is with the My Home Assistance, you can borrow up to $15,000 or 3 or 3.5% of your purchase price, but the maximum is $15,000. It is a low interest loan, and you're not required to pay back that assistance until you either sell your home or if you refinance in the future. The state does charge you a 1% simple interest rate. So if I, let's say, took a $15,000 assistance loan, it would be $150 per year, but that's simple interest. So it doesn't compound $150 on top of $150 each year. So that can solve for, like, let's say I'm going to buy at $500,000, which I'm going to show you an example in a second. That could potentially qualify or cover your entire down payment amount for your home purchase. Now with home buying, we also learned that we have closing costs, and that's where ZIP assistance can also support you there. ZIP stands for Zero Interest Program because it truly is an interest-free program. It is an interest-free loan provided by the state where you can get up to 2 to 3% of your loan amount for closing cost assistance. Okay, so that can be another great solution for you as well to help with your home buying. Now, if you're a public school employee, fire department employee, or potentially maybe you're buying new construction, that $15,000 maximum gets waived. So you can get the full 3% or 3.5% of your purchase price. So let's say, for example, we're going to buy a $600,000 new condo in LA. Well, the minimum down payment at that level usually is 5% because we're going beyond the 548 loan limit. So that would be $30,000. However, if you're buying new construction, you would get 3% or $18,000 towards your down payment requirement. So you wouldn't have to worry about the maximum of $15,000. So really cool features of the CalHFA assistance program. Let's look at an example of what it could look like if I'm going to buy, let's say, at $500,000. So as we learned earlier, the minimum down payment is 3% for a $500,000 home price. So that would be $15,000. So we would need to save that, plus we would need our closing costs saved, which should be anywhere between $10,000 to $15,000. So I would basically need about $25,000 to $30,000 for my home purchase. So if that's a bit of a stretch for us, or maybe that's going to completely exhaust all of our savings, that's where the assistance program can be a great tool to help us reach homeownership a little bit quicker. So if we look at the bottom scenario here, so we take the same loan with CalHFA assistance. Now we're going to purchase at $500,000 still. But instead of having to worry about this $15,000 down payment here, we're going to get assistance of $15,000 to help offset that requirement. So now I don't have to worry about my down payment at all. But I can also get the $9,700 to $14,550 in ZIP assistance, that interest-free assistance, to help towards my closing costs. So now it's really, instead of paying 25 to 30 out of pocket, I could take both of these programs if I wanted to utilize them and get anywhere between 24,700 in assistance to 29,550 in assistance. And that can be used to help offset my cash to close figure. So versus that pretty big requirement of 25 to 30, maybe I'm paying 3,000 to 4,000 out of pocket and making homeownership a little bit closer for me. Okay, now those numbers will vary a bit based upon the purchase price we're looking at, where we're buying. Just a side note, most properties are eligible for this program, but it does have to be a primary residence. It doesn't have to be occupied by you. Condos are eligible, townhouses, half plexes. It cannot be a multi-unit property, so 2 or 3 unit properties are not eligible. If you're looking, manufactured homes are actually eligible. However, manufactured homes have to be on land that is owned. It can't be like in a mobile home park like that. There is some eligibility components to the program, and they're pretty lenient versus other first-time buyer programs, because most first-time buyer programs have some pretty significant income restrictions. Usually some of your local, like maybe LA City or LA County or maybe City of Irvine, first-time buyer programs are restricted to 80% of the median income and less, which can be a bit of a challenge to qualify. And so this, as you can see, Orange County, you can make up to $211,000 and potentially qualify for the program. The minimum credit score for the program is 660. The maximum debt to income ratio that we learned about earlier is 45%. The income qualification is based upon the applicant's income. So let me kind of expand on that a bit. So if I'm going to apply together with my spouse and I make 150 and my spouse makes 100,000 a year, so together we make 250 and we're trying to buy in Irvine, well, we combined exceed the income limits of 211. However, if we can apply in just my name because I make 150, then we would fall within the income limits and potentially be eligible for the assistance program. So that's a great way of having some flexibility. With most first-time buyer programs, like I mentioned, are going to be less than 80% of the median income. They also look at household income, whereas the state assistance program is just looking at the applicant income. Now, a first-time buyer is someone that hasn't owned in the last 3 years as their primary residence. So if you haven't, maybe let's say you owned a house back in 2009 and sold it in 2011, but you've been renting ever since, you're considered a first-time buyer. If you purchased a home and it's always been a rental property, you've been renting for the last 3 years, you are also considered a first-time buyer.
There's a question.
Sure.
Can a teacher use CalSTRs for down payment if they need to?
So the question is, can a teacher use CalSTRs for down payment? I don't know. From a lending perspective, if the asset's liquid, they could totally use that. I don't know if a STRS retirement is liquid though. There may be some options to borrow against the retirement, but I think it's not accessible until retirement age, but I'm not totally sure. These are the income limits by county. So we kind of have these more focused around the Southern California market. So Orange is 211, LA's 158. You can see Riverside, San Bernardino, and Ventura, along with San Diego there. If you're up in Northern California, some of the Bay Area markets are very similar to what we see in Orange. I think it's closer to like 220. If you happen to be joining us from the Sacramento area, you can make up to $180,000. So they are, like I said, quite lenient from an income perspective. So it's really designed to help more low to moderate income households. And as we get into the more expensive cost of living areas, it can be a little more challenging. So that's the CalHTV assistance program. That's something we can dive into as we design a home buying game plan. If you think you could benefit from that, we'll certainly make that as part of one of your resources available to you. Speaking of resources, we also have a medical professionals program. So if some of you are joining us from UCI Health or some of our other partnerships that have a health component to them. The medical professionals program is great for medical doctors, dentists, medical teaching professionals, or licensed medical residents. So where this kind of fits in a bit is for clients that are buying that are beyond the high balance limits, because it has reduced down payment. So if we start going beyond 822, 375, or especially when we're buying out in San Bernardino or Riverside County where there's lower conforming limits, if we start going beyond those, this would allow you to put as little as 3 to 5% down, even though you're beyond the limits and you start falling into the jumbo loan category. It also benefits you because there's lower minimum credit score requirements. The debt to income ratio is a bit more flexible. And probably the biggest thing we see is flexibility around student loan payments. So generally with the medical professionals program, student loan debt is not counted against you when you utilize a medical professionals program. So that's a great tool to help out with, some of our medical residents that are just getting started. And that's, again, another tool that we can look at as part of your consultation. Okay, so we're going to talk about the steps of home buying now. So this is our 6 steps of home buying to kind of walk you through what it looks like to be pre-approved all the way to step 6 when you get your keys. Now, before we get to step 1 in the home buying process, which is pre-approval, it starts with a consultation. Now, a consultation is usually done either via video or via phone, and that allows us to go through your monthly budget, design some goals, walk you through the home buying process, help coach you around credit, and ultimately get you in position where you have a really good game plan together and get you pre-approved. So when you do decide you want to take the next steps in home ownership, you're completely prepared and ready to go. We're going to talk a little bit more about what a consultation is in just a second, but that's a free service we provide to our buyers just getting started in the process. But once we get pre-approved, that'll take us to step 1. And pre-approval is a certificate that you can provide when you decide to make an offer on a home to a potential seller. Now, right now, especially in this environment, we're still in the pandemic. Sellers won't even show homes right now unless you're pre-approved. So we always recommend getting a pre-approval. Now, other lenders will have differences between pre-approvals and pre-qualifications. We only do pre-approvals, which basically has us reviewing your application, your income, your credit, and your assets. Pre-qualifications just simply look at your application and your credit. And quite honestly, in this competitive market that we're still in, pre-qualifications don't really hold up to be able to make you competitive as a buyer. So we really encourage pre-approvals. So again, that's a certificate and it's the output of your consultation. Step 2 is house hunting. So that's the fun part. So that's when you get a chance to partner with a realtor, look at different options, whether new homes or resale homes, whatever the case may be. And eventually when you find a home that maybe fits right for you and your budget, then you can make an offer on that home. Now, when you're searching as a buyer, realtors will be really instrumental in helping you negotiate, not only just find the right house, but negotiating with the seller. And so we really encourage you to take advantage of that resource. We do have preferred realtors we work with across the West Coast. So if you're looking maybe in the Irvine market, for example, and you want the help of a realtor, we can introduce you to one of our preferred realtors as part of the process. These are independent realtors, but we really trust them to create the kind of ideal experience that we want to have for our buyers and working with them on the lending side. Now, if you submit an offer to a seller, and that'll move us into step 3 if that offer gets accepted, and that's called entering escrow. So that means you have a ratified agreement with the seller and it starts the escrow time period. The escrow time period is usually 30 days. So from the time of acceptance to the time you get your keys and your high five and your friends at step 6 takes about 30 days. So that's what you should expect. In some cases, it's 21 to 25 days. Now, in this seller's market, what we are seeing is some sellers want to sell their home, but they don't have a replacement property. So in some cases, you're having to close escrow in 30 days, but you may not get access to the property for another 30 days. That's called a rent back, where you might have to rent the property back to the seller after you purchase it. That gets a little bit complicated, not a big deal, happens quite often in this market because sellers just aren't prepared to move yet until they actually sell their home. So, but generally as a rule of thumb, it's 21 to 30 days for your escrow time period. Now, once you have an accepted offer at step 3, you as a buyer will be required to make what we call an earnest money deposit. That's usually 1% to 2% of your purchase price. That's a good faith deposit that you place in the escrow title company, and it's held there while you go through the escrow process. Okay, that money counts towards your total out-of-pocket expense. So if I'm expected to bring $30,000 out of pocket and I've made a $4,000 deposit, that $4,000 will show as a credit against the $30,000. So potentially now my net out of pocket is $26,000. Now, within 48 to 72 hours of step 3 here, we're going to get together for a follow-up consultation. And that's where we're going to review your different home buying options. We're going to talk about interest rates, your payments, your total out-of-pocket expense. So you're going to have a really clear, transparent idea of what it looks like for the construction of your loan. And then we'll kind of set the stage for what's to come in step 4, 5, and 6 of the process. So that's called a follow-up consultation. Now, what's also going to begin at step 3 is what we call the contingency period. And contingencies have shifted around a little bit, especially, in the seller's market, where sellers were not maybe giving buyers as much of a contingency as they would like to have in the purchase agreement. But overall, the contingency allows you as a buyer to do your due diligence on the property, to be able to do your homework. So that homework includes getting your house appraised, which us as the lender would order and report back to you once we have the value of the property, getting the house inspected, which basically would be orchestrated by your realtor. So there's a variety of different inspections you can do. You can do a home inspection, roof, sewer, pool, HVAC, whatever you think is going to be in your best interest to give you peace of mind that this is a sound investment for you. And then finally, loan contingency. That's where we get your loan approved as the lender for you. And by the way, we're a direct lender at American Pacific Mortgage, so we're handling that all internally. Usually the contingency period lasts in the first 14 to 21 days of your contract period. So from step 3 to step 5 is that contingency period. What that contingency does is, again, allows you to help kind of process all the information, make sure you feel comfortable about everything. And if you, for whatever reason, have a negative inspection or a bad appraisal, or maybe just have some challenges overall with the home, you can cancel the transaction and potentially get a full refund of your deposit. That's why it's called a contingency. Now, moving along here, step 4 is processing and underwriting. That's where we're going to be doing the administrative functions of the loan process, which would include verifying your employment, ordering your appraisal on the property, verifying maybe your tax records, and getting everything organized so we can send everything to underwriting. And underwriting's a process where someone physically kind of goes through all your income, assets, your credit, make sure it's all set up correctly, and then approves your loan at step 5. By the time we get to step 5, we'll actually even be to the end of your contingency period. So by that time, we'll have your loan approved. Your appraisal should also be back. You should also have your inspections as a buyer. And if everything is sufficient for you and you feel still good about the purchase of this property, you're going to sign off on the contingencies. You'll generally docu-sign that. That tells the seller that you feel comfortable in moving forward and that you're ready to go to the final stage of closing the loan. Now, it's important to know that as a buyer, once you sign off on that contingency, then you're telling the seller you want to move forward. So if 2 or 3 days later after docu-signing that, you decide to cancel, then you could potentially risk losing your deposit. So you really want to make sure you feel comfortable with everything before executing that signature. The final thing that's going to happen at step 5 is we're going to issue to you a final closing disclosure. That's going to give you a 3-day cooling off period before we move to the final stage called closing your loan. That's at step 6. And that's where you're going to be signing final documents in person with a public notary. That needs to be done via wet signature because everything up to that point leading up to step 6 can all be done via e-signature, but that final set of signing has to be done in person with a public notary. So that takes about an hour to maybe an hour and a half, depending on the structure of your loan. Once you've completed that, then you're going to wire in the final funds for your financing. So if you owe, I think we said $24,000 or $26,000, that final cash to close will be made at step 6. Once that money has been all accounted for, the escrow company will make sure everything balances. So you've contributed the proceeds that you're supposed to as a buyer. Seller is receiving their net proceeds that they're supposed to receive. After all that's done, then us as a lender will wire in the mortgage funds. If you elect to have maybe the CalHFA assistance program, we also fund that along with your loan. That money is reconciled with the escrow company. And if everything looks good, they'll record documents with the county recorder's office. So let's say we're buying in Orange County. They'll record a grant deed, and that basically transfers ownership from the seller to you. And they also record a deed of trust, which is your agreement to repay the loan. And once all those recording confirmations are brought in to the escrow company, that's when you become the official owner of the property. So that's when you can high five your partner or tell all your friends and family about your big purchase. Celebrate it on social media because it's probably one of the biggest investments you make in your lifetime, and it is a big deal in home ownership. So that's what it looks like as part of the kind of the 6 steps of home buying. Now, I mentioned to you before we kind of start on that journey of step one of the pre-approval, there is what we call a consultation. The consultation allows us to put together that home buying game plan. And like I said, that's either done via phone or via video. And we'll kind of build that comprehensive plan for you. So that usually takes about 30 to 45 minutes. If you're ready to kind of start building that or want to kind of start getting situated with your consultation so you can figure out your game plan, under the consultation phone video information, you can see kind of what's required. So there's kind of a 3-step application process. You'll do your online application. You can upload your last couple pay stubs, W-2s, your recent asset statements, and then you'll just click on the schedule appointment, and then you can schedule either a video or phone call. And that, like I said, takes about 30 to 45 minutes. Okay, and that's a free service we provide. So whether you're buying next month or next year, we want to help kind of be part of the plan of getting you in position to be able to purchase. Now, leaving this workshop, if maybe you have some questions that just didn't get answered today, or you want to kind of just go through some different interest rate scenarios, an intro call is a great way to do that. You can click on the schedule an appointment here if you want to just book some time with me to kind of spend the next 10 to 15 minutes. That's also a free service. We just want to provide value to you. So, we can just be a partner for you that when you do decide to purchase, whether it's next month or next year, you kind of have all the resources you need at your disposal. This is the framework of a consultation. So I've kind of talked about it a few times tonight, but it's, understanding your budget, where do you want to go with different short and long-term goals? What's affordability look like to you? Where are you looking to purchase? What type of property you're looking to buy? What's the application process look like? We'll kind of make sure your application information is all dialed in. And then, we'll talk about the benefits of partnering with a realtor. If you do want the introduction to one of our preferred realtors, more than happy to do that. And like I said, the output of a consultation will hopefully be to have you guys pre-approved and have you on your way to home ownership. So you're probably joining us through one of our partnerships. This is primarily a UCI alumni discussion we're having this evening, but we have a variety of different partnerships across the West Coast. And so we try to provide discounts for closing costs in those partnerships. So as part of the UC Irvine and other partnerships, we have a discount that basically takes our processing fee, which is usually $910, and reduces that down to $160. So it's a bonus of $750 in discounts. So it's a really cool program. And so if you're not joining us through the UCI Alumni Partnership, as you can see here, there's other partnerships that we have affiliations with as well too. And we do provide access to all these great programs that you heard this evening. And like I said just a few slides ago, this is probably one of the biggest investments you're going to make in your lifetime. We understand it's a big decision, and so we really want to be your trusted mortgage advisor throughout this process. And we really want to help with the education of the process and be more of a consultant with you as you kind of take on this journey. Now, we have a lot of great tools that are available to you. We have the mobile app, and so you can download that using the slide here for Android or Apple. You can even start the application right from your handheld. You can upload documents, and you can actually track the progress of your loan right through our APM mobile app. So a really cool tool to be able to use. And you can also do the different calculations, or use the calculator, I should say, that's on that mobile app as well. Here is all my contact information. So if you do have some follow-up questions, you want to connect with me, feel free to text me, email, call, whatever's good for you. And then check us out on our different social channels on Instagram, Facebook. We have some fantastic testimonials on Yelp, Google, and a lot of those testimonials are from audience members just like yourselves that attended our workshops over the last 6 to 7 years. We're really proud of kind of the experiences we've created for future home buyers, and we really love for you guys to be one of our next clients, I guess, if you will, to celebrate those same memories of home ownership. So a lot of great stuff to share there. So kind of going forward, we're going to hang out a little bit longer here to answer any questions. I don't know if we have some stuff that's come in. We'll keep everything live for a little bit. If I don't get a chance to connect you, I really appreciate you joining this evening's discussion. Hopefully it was helpful for you. Hopefully kind of allows you to kind of get a sense of what it could look like in taking the next steps towards homeownership. And if you do like to connect with an intro call or even a consultation, we're here to help you with that. Okay, so we'll hang out for just a little bit longer for some Q&A.